Hola, welcome to Basics Simplified. Today we are going to be learning about the very last quantitative monetary policy tool, that is bank rate. And bank rate is used by banks for long-term requirement. You could also say long-term goals to make it pretty much simple. Okay, if a bank has a 5-year target of achieving something and they borrow for achieving the target, it comes under bank rate. Okay, so first let's see how bank rate behaves. Bank rate is defined as borrowing money from the RBI by a bank, by any commercial bank, for a rate of interest. There is no security involved, there is no pledging of asset, nothing. It's more like a trust based loan. Okay, since it's targeted for a long term requirement, banks easily get this loan, but it also has some conditions or some negatives attached to it. Okay, so let's see how it behaves. Okay, so assume a bank wants $100 million for a 5-year target. Okay, bank wants $100 million to achieve some 5-year target. So it borrows from RBI the $100 million at, you could say, 5% of interest. This interest is your bank rate. Okay, and it pays back to the RBI the 100 million plus 5 million, totaling $105 million. Pretty simple, similar to how we learned repo rate and stuff, right? So how does bank rate differ from repo rate? Repo rate is used by the Monetary Policy Committee to control inflation. Okay, inflation and the present situation of money supply in the economy, how the economy is behaving. Bank rate is used by the MPC to control the long-term money supply and the whole economy for the next few years itself. How? Repo rate is taken up for inflation matters, right? Bank rate, when a bank borrows under bank rate for a 5-year plan, any company which is taking a loan for a long period, like 5 years, their whole loan, that large loan, gets affected by this. So assume the same ABC bank, they want $100 million for 5 years. Okay, Ashok and Leyland or some company like that steps in and asks for a 800 million loan, or 80 million loan for 5 years. For that loan, the rate of interest they charge will be, if bank rate was 5% and the bank got 100 million for 5%, it would charge 5% plus another 2% as 7.5% or something to that company, Ashok Leyland or whatever. Okay, so they will be getting a $80 million loan for 5 years at 7.5% interest. Okay, now what happens if bank rate is increased? These are all things we already know how to do. We'll just go ahead. It borrows the same $100 million from RBI, but the rate of interest is now 7%. So it pays back $107 million. Okay, and since the rate of interest is 7%, that $80 million that the company wanted would now be costing 9.5%. Okay, and when bank rate reduces, save 100 million, instead this is 3% interest this time, and the bank pays back $103 million. Now in this situation, it would only cost a company 5% of interest. So that company would prefer borrowing under this interest regime than this interest regime. Okay, this is cheaper, they pay back lesser, and it's good for them. Okay, so when bank rate is involved, it determines the whole economy itself for the next few years instead of inflation for the short term time being. Okay, now you would be seeing this and be thinking, okay, so what is the most important difference between bank rate and repo rate? There is no security. No security, it's without security. You borrow money for an interest, you pay back the money with interest. There is no security. Okay, now how does it differ from repo rate in any other instances? Okay, the most important difference is bank rate is always higher in interest than repo rate, because you'd be thinking the bank is getting money for a rate of interest without having to pledge any securities. Why are they only doing it for long term requirement? Why not do it for short term? Why not do it for inflation? The reason is bank rate interest will always be higher than repo rate. So if repo rate is say 4%, bank rate would be 4.25 to 5% or higher. Okay, it will always be higher than repo rate. That is why banks prefer borrowing under repo rate. Okay, which is cheaper. So if bank rate is 3%, repo rate would be 2.75, 2.5 or 2.2%, even 2%. Which is cheaper to borrow? 2%, right? So that's the biggest catch. Other than the fact that they don't need securities and a bank rate, it is costlier than repo rate. This is the major reason why banks do not misuse bank rate. Banks actually prefer borrowing under repo rate. Okay. Now we know this. There's another term which you would come across when you're learning about bank rate. It's called overnight rate. Overnight. You'll be thinking, isn't some of the borrowing rates actually overnight borrowing? That is true, but there's an exact term called overnight rate. So if banks borrow from RBI, it can be done to three things: repo rate, MSF and bank rate. If banks borrow from another bank, that is interbank trading, it's under overnight rate. Okay, so how does this behave? Pretty much the same way. Banks borrow, let's say $5 million. Okay, bank A borrows from bank B $5 million. This bank will charge a rate of interest which this bank will pay back. If the rate of interest is 5%, this will pay back that 5%, which would be 5.25 million. Okay. Max might be a bit wrong, but essentially the banks will fix the rate of interest. That rate of interest would be actually determined on this, but to some extent it's more like borrowing between friends. You charge an interest, I charge an interest, you give me money, I'll lend you money. The same way. Okay. So now we know how this behaves, how bank rate is different from repo rate and what is overnight rate. Okay. And that's it for the quantitative tools of the Monetary Policy Committee. We will be looking at inflation and other topics in the upcoming videos. Thank you.